everybody, I'm Tony Dwyer, Chief Market Strategist at Canaccord Genuity and main driver of DwyerStrategy.com. So the big question is, what does the next 6 months look like? And can you imagine if somebody asked you that question 6 months ago? Would you have expected a global pandemic that would drive the market down to the fastest decline in history, followed by the fastest recovery from a bear market in history? It has really been a fast and furious market. So there's a lot of things that I wouldn't have expected to happen. So what I'd like to do is take you through what our outlook is over the course of the near term in our macro market outlook. So our fundamental core thesis, we just recently moved our target to 3,300 plus for the S&P 500. So we have two ways to look at the market. We have the fundamental side of the market and the tactical or technical side of the market, which we use history, sentiment analysis, and high use of oscillators, which kind of offsets the whole algorithmic impact into the marketplace. So our fundamental outlook is driven by low inflation, creates an ultra easy Fed, and available credit, and it has been extraordinary what we've heard from the Fed over the course of this last few months, which I'll get into a little bit. Then that excess liquidity and that super easy Fed allows the economy, once there is a vaccine, and there's a lot of news coming out, even recently, on the importance of vaccines that are beginning to show signs of working. But with the amount of liquidity we have in the background, that could act like a light switch. So we believe that over the course of the next 6 months, 6 to 12 months, the market's going to continue to move higher, even with the political risk, even with the risk of increased COVID-19 cases in the southern states. There's clearly some fear of that. That may create near-term volatility, but the intermediate term looks very good from a fundamental basis. What really drives the whole thing and what has allowed the Fed to have the policy that they've had is low inflation. As you can see on this graph, the core PCE, which is their favorite inflation gauge, is historically low at just 1%. I mean, think about this. The Fed has two mandates. The two mandates are full employment, currently at 13.3%, and 2% sustained inflation at 2%. It's currently at 1%. You're nowhere near where they need to be for both of their mandates. I really believe that it's going to be a very, very long time. I'll probably be retired by the time the Fed actually lifts rates off the zero bound level. The inflation rate is just simply too low. The Fed we were talking about a generational change in the Fed as it relates to inflation well before the COVID-19 economic shutdown, because you had this 10-year inflation break even, reinforcing that Fed fear. Again, look at the trend of that prior to 2020. You were seeing 10-year inflation break-evens well below 2% before you heard anything about a COVID-19 virus and an economic shutdown. If you're the Fed and you're sitting there and you need to see sustained inflation at 2%, and it's nowhere close to that, and 10 years from now it's telling you the 10-year inflation break-evens are saying it's going to be at 1.31%, you're a lot more scared of deflation than inflation. And there is a ton of money printing, which I'm going to go into in a second. But at this point, someday there will probably be inflation. Too much money chasing too few goods. There is an incredible amount of money that has been produced. But we don't have to guess when that's going to be. We can watch this 10-year inflation break-even level and see when you are getting an uptick in inflation, and we're just not getting it. And what that allows for is a Fed funds to go back into real Fed funds to go back into negative territory. And what you see on this graph is that you've had a lower peak each cycle in the real Fed funds rate. That lower peak is coming as a result of the excess debt. You know, when you have exponentially more debt, a slight uptick in rates is going to slow economic activity. If you only have a little bit of debt, you know, you can get rates to 9% before it really has a dramatic impact. But when you're seeing an increase in rates with the kind of level of debt that we have, it happens a lot faster. And in turn, you have a lot longer duration each cycle of a negative real Fed funds rate. In other words, an ultra easy Fed. We're just in the beginning of this one. So we have the low inflation equals ultra easy Fed, And that has really helped corporate credit. The things that the Fed has said this cycle are bananas to me. I never thought 3 months ago that I would ever hear a Fed chairperson say, we're just printing money. He didn't even, on the 60 Minutes interview, the CBS 60 Minutes interview that Fed Chair Powell gave, he literally said in response to a question, he didn't use quantitative easing. He didn't use Alan Greenspan's terms of that none of us could understand but had to guess about. He looked into the Fed chairman looked into the camera and said, we're just printing money. And the anchor asked what is going to be the consequence of that. And he said, well, now is not the time to worry about that. There's unlimited support for the credit markets until you see a sustained recovery. What that did was create an absolute surge in corporate credit new issuance and massive buying of corporate credit. The Fed throughout this pandemic from March 26 on has supported buying corporate debt. They're buying corporate debt, not just the ETFs. They're actually buying individual company bonds. They set up a trading desk. They're buying individual company bonds. That is an incredible movement into risk. So what happened is without them even having to buy that many bonds, you can see the current downtrend in the corporate credit spreads relative to the 10-year note yield. So you have this incredible low inflation, ultra easy Fed that says they're not going to stop printing money. It's generated a historic corporate credit new issuance, which funds corporate America. And you can see that through the spreads. And what all of that is doing is creating a historic ramp in money supply. Money supply is up over 20% on a year-to-year basis. The Fed literally told you they're not going to stop printing the money. And you've already had this incredible historic surge in money supply. When you look at this graph, money supply is double the growth rate of any time in our country's history since we began measuring this metric. Okay, so that to me is what's the risk of that? What does that mean? The only risk to that is that money supply is being created, that corporate credit new issuance is being done. You need to see a vaccine and an economic reopening, or all that does is fund companies to stay in business. What we want to see is kind of that light switch go off, where you get a vaccine, the economy reopens more aggressively, and there's still so much of this money in the system that it can be put to work in terms of growth. So what we did is quantify, with the help of our friends at Ned Davis Research, we quantified what excess liquidity looks like and what it means to the S&P 500. On this graph, you can see that the real liquidity, which simply measures, I'm going to take a little bit of economic ease and put it into English. What this measures is the money supply plus mutual funds and bond, equity and bond mutual funds and ETFs actually. When you measure all of those against what kind of money is needed for economic growth, industrial production and inflation, the excess of that is what this red chart shows you. So in other words, your excess liquidity, there's so much money that's there. It's not yet being used. It's sort of like if you look at the 33% savings rate that we had 2 months ago. A lot of money is being put into that's ready to go into the economy. It's just sitting there waiting to see what happens when you've had this kind of excess liquidity, which you can see in the peak where those arrows are. It has been good for the stock market. It traditionally does not happen anywhere near the end of an economic cycle. And actually, when you look at it, it happened toward the end of 2009, right? And that was the beginning of the bull market. What that has created is all this money creates easing financial conditions. So what the Fed did in an extraordinary move, I've kind of remembered the Fed of, something happens and they study it, and then they have a meeting about how to study it, and then there's another meeting about when they're going to have a meeting about what to do about it. This Fed was aggressive, right? They did not do the wait and see, let's study what's happening. Right away, the Fed went to buying corporate credit. March 26th at the turn, that's what generated the first leg higher. We're going to buy investment grade debt, all right? They only said they were gonna buy it. They didn't even start buying it yet. And then April 9th, which we called a game-changing Fed decision that took the worst case off the table, they announced that they're buying various areas of high-yield debt, right? That is a movement into risk that was very aggressive. And what that told lenders and banks and financial, it created, it very quickly reversed that uptick in tighter financial conditions. But the real turn in this data series, the real turn in credit, what really kind of got things moving again, literally was that 60 Minutes interview in our view. That 60 Minutes interview showed how willing the Fed was to put all the kind of BS aside and just say, we're printing money. We're going to provide money. We're not going to get into the Great Depression. We're not going to tighten financial conditions too quickly, which is exactly what extended the Depression from 1932 on. They tightened too quickly because of the money supply growth. It has really been extraordinary. So what we've had is, off the bottom, we had the greatest drop in economic, in the Citigroup Economic Surprise Index that rivaled late 2008. But we've had a surge back that has never been seen before. My buddy Jason Gofford at Sentiment Trader did a study on this as well that suggested ultimately that's good for stocks. So here's what we have. We have low inflation, super easy Fed, huge amount of money around. The economy is beginning to turn off the low, which is better than expected, as seen in the Citigroup Economic Surprise Index. And a lot of it is behind home ownership and housing, where you're getting an uptick in the home ownership rate. Remember, the millennial demographic, it was going to be they were going to live in New York City, never own a car, never own a house. Well, that you couldn't be further from the truth on. You're getting a historic decline in interest rates. There's so much money available, as I mentioned. The banks have eased their lending standards. You know, you're seeing an easing financial conditions in the prior slide, and that is creating a home ownership rate that's trending higher off that generational low. It's a really big deal because housing and housing related drives a lot of the consumer-based economy. Globally, we're also seeing a nice turn. This is the OECD, which measures 36 countries' economic activity. They produce a composite leading index for all those countries. And on the top, what you'll see in the headlines is, you know, the OECD composite leading indicators are at the worst level since 2009, and then the story will go on. What I like to see is are there any signs of a turn? And the answer is very clearly yes. You're seeing the shares in the middle graph, the shares of the CLIs posting positive monthly changes. You're seeing that surge off the low. That is what happens coming out of a recession. And I think it's a very positive influence, not just the domestic economy with the money that's being produced. This is a global thing. You had a global shutdown. The global monetary authorities are just putting as much money into it as they can. So what that created was, initially you got that lift off the low. On this chart, you can see that you had that incredible decline. We had turned cautious on January 20th. We downgraded our market view. Obviously, I didn't expect a 30% drop because COVID at the time wasn't really a thing. We got that 34% drop, and then you got a historic oversold condition that clearly warranted a reflex rally. The reflex rally, when you get as oversold as we got to on the week of March 20th, when we use it, a 14-week RSI, suggests you get a 17% jump followed by a retest. The Fed clearly took the retest out of the game with that April 9th decision to buy various areas of high yield debt. But that sent the market into a trading range. It didn't really know what to do. We didn't know what the vaccine looked like, what any kind of treatments looked like. So we went into this 200-point trading range, and when we broke out of that, the gap out of that came from the 60 Minutes interview. And once you did that, it was as soon as Powell said on 60 Minutes, we're just printing the money, the banks, the tanks, the industrials, materials, consumer discretionary X or equal weighted Amazon, so take away the Amazon effect, they all went bananas higher. It got up to 3,200, and we thought that was a natural place to rest, because you take the 200-point spread, right? You reach your target of 3150 because you broke out at 2950. And our plan now is we want to buy this consolidation period as the market pulls back toward 3,000, S&P 3,000. What really drove our decision to on June 5th to say that the market was going to enter a consolidation phase was this chart here, in large part. The only time that we can find a 10-week rate of change on the S&P 500 to jump 30% was back off the initial 40% move. Yes, I said that right. 40% move off that 2009 low. very similar. You got this ramp higher off of an extreme oversold condition that produced a 30% rate of change in the 10-week rate of change for the S&P. You went into a 7% decline that took a little over a month before your next leg higher. So on June 5th, we had noted that there was a downtick in that 10-week rate of change. And when that happened in the past, that's what kicked off that period of consolidation. What was especially important about this market move was the breadth thrust. We're all familiar with the term "don't fight the Fed." There's also the term "don't fight the tape." This chart here shows you those blue arrows are when 90% of S&P components are above both their 10 and 50-day moving average, and the green arrows represent periods where your 90% of S&P stocks are above their 50-day moving average for at least 10 days. So a very long duration breadth thrust. The green arrows, I think, are really important. And what it did, we went back and we looked at times where those green arrows happened, and you can see it on the chart. You went immediately into a period of consolidation that lasted multiple weeks or a couple of months. That also drove our view that you were going to get a consolidation period. But clearly, we want to buy it for the next 6 months outlook. So we've gone through the fundamental side. We've got seriously low inflation with no signs of inflation on the 10-year inflation break even, an ultra easy Fed. They've told you they're going to continue to print money. Money supply and excess liquidity is beyond historic. You've got a turn in economic activity that's surprising everybody based on the Citigroup Economic Surprise Index. You got the tailwind of a millennial demographic moving into homes, so the home ownership rate is moving higher, right? And you've got a global economy that's beginning to recover from a historically weak period. That's a good fundamental outlook in our view. So again, that's our 3350 target. 3,300 S&P 3,300 plus. I use the plus because what multiple do you put on an unlimited Fed easing? So let's turn to some of the tactical data. Again, my buddy Jason Gopher did this study with us where we looked at times where the percent of S&P 500 components above the 50-day moving average goes from greater than 90%, which we showed you in that prior slide, to less than 50%. So you're consolidating that first real breadth thrust higher. Just look at the returns over the next 6 to 12 months. At some point, you're going to get a massive double-digit return. 100% probability, looking back, this, of course, since 1990, 100% probability a year out of having a gain with a median gain of 18%. I'm only looking for 10%, my fundamental target. So again, I think our target over the next 12 to 18 months is pretty conservative, where the upside can happen from a quick reopening of economic activity, coupled with a valuation expansion, supported by the history of what happens after that initial breadth thrust and when it consolidates. We also went back, one of the pushbacks that some of you will be familiar with is, yeah, but the market got so overbought and you still have this elevated volatility. Well, we did a study that looked at times where the S&P 500 weekly 14-week stochastic indicator got overbought, an overbought extreme, meaning over 80, with a VIX greater than 30. So you had a very overbought market with still elevated volatility, meaning you could see increased levels of fear drive high fluctuations in the market. Look at the 6 and 12-month returns here. Your worst case on a 6 months was 8%. Your worst case on a 12 months was 16%. So again, I turned to my buddy Jason. He did some kind of, in his wizardry that he uses, he did some kind of synthetic VIX, and going back to 1962, very, very similar data with a lot more occurrences. So our view continues to be that we're in this period where you have a lot of uncertainty about the political environment. You have uncertainty about a reopening of economic activity because of the resurgence of COVID-19. That was all expected to happen later in the year. In other words, what happens in September when we get a second wave? And what happens if Joe Biden looks like he's in the lead? As that would mean higher taxes. He's already told us it's going to mean higher taxes. The amount of leadership he's having right now in the polls is pulling forward the political fear, creating a little bit of angst now. And of course, the southern states going back to closing down a little bit are certainly not reopening as they had planned. because of the increased cases of COVID-19. Those two fears for later in the year, I think, are what is creating a little bit of choppiness now. We want to, using the fundamental data we've looked at, using this tactical data with a historical backdrop we've looked at, we want to buy weakness as it plays out, especially if you get into the S&P 500 moving to or below 3,000. So thank you very much, and hopefully you enjoyed the presentation, and have a great day.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.